The Federal Reserve has once again lowered its benchmark interest rate, marking the second time this year that the central bank has made such a move. While the decision was widely anticipated, the timing of this rate cut raises some significant questions. With the U.S. economy at a crucial juncture, the economic landscape is shifting, especially following a tightly contested presidential election. This recent quarter-point reduction comes amid signs that inflation is slowing, but the potential for economic risks looms large. What does this mean for the future of the U.S. economy, and how will the Fed navigate its next steps? One of the main reasons for this rate cut is the easing of inflationary pressures. Over the last few years, inflation had surged to uncomfortable levels, hitting Americans' wallets hard, particularly in areas like housing, groceries, and transportation. However, the pace of price increases has significantly slowed down, allowing the Fed to adopt a more dovish stance. That said, Fed Chairman Jerome Powell made it clear that the job isn't over yet. Inflation has cooled, but the central bank remains cautious about overestimating the situation. The path toward the Fed's 2% inflation target remains bumpy, and risks still exist. The timing of this decision, though, is far from ideal. It comes just days after the U.S. presidential election, which saw President-elect Donald Trump securing a return to office. With Trump's policy proposals, particularly his plans for large tax cuts, tariffs, and a more aggressive stance on immigration, many analysts believe inflation could spike again in the near future. This raises the possibility that the rate-cutting cycle could be coming to an end. The Fed's recent actions, coupled with its less confident language regarding inflation, suggest that it might need to reassess its approach in light of the new administration. Another complicating factor is the housing market. Despite the rate cut, mortgage rates continue to rise, which runs counter to what one might expect when the Fed lowers its rates. Mortgage rates are tied closely to Treasury yields, which have been rising as the economy outperforms others globally, and as investors factor in Trump's economic policies. The Fed is cautious about taking further action without fully understanding how these broader market forces will play out. As we look ahead, the Fed's ability to respond to economic data and adjust its policies will be critical. There is uncertainty about the trajectory of inflation, especially with the looming risks of policy shifts under a second Trump administration. The Fed's job, however, will remain to strike the right balance between fostering economic growth and ensuring inflation stays in check. As Powell said, the central bank is prepared to adjust its approach as new data and developments unfold. For now, we may be witnessing one of the last rate cuts in this cycle, but as always, the economic landscape remains fluid, and much will depend on how the U.S. economy responds in the months to come. Stay subscribed for more videos.